and welcome. Today we are going to explore an interesting aspect of real estate transaction. So the use of seller financing in a 1031 exchange. So the big question on the table is, can you use seller financing when selling and buying properties in a 1031 exchange? The short answer is yes, you absolutely can. Seller financing is a strategy that involves the seller accepting a down payment and carrying a note for the remaining balance of the property. This arrangement can be quite beneficial, especially for buyers who are exploring alternatives to the more traditional route of securing loans from financial institutions. So let's break it down a little bit. When we talk about seller financing, we mean that the seller is essentially becoming the lender. So instead of the buyer obtaining a loan from a bank, they're making a down payment to the seller and then paying off the remaining balance through a series of agreed upon payments over time. This approach can be really attractive to buyers who might find challenging to qualify for a conventional loan or who simply prefer a more flexible arrangement. Now, why might someone choose this route? Well, in today's market, interest rates are rising significantly, and the ability to secure a loan is also more challenging than before. So for the buyers, seller financing provides an alternative financing option that doesn't involve the complexity and potential challenges of dealing with a financial institution. This can also be a way to expedite the sale process. Imagine being able to close on a property quickly without having to wait for the lengthy approval process of a traditional loan. Seller financing makes it possible, right? So how can I do a seller financing 1031 exchange combo? Well, option one, you can cover the note with cash. So basically, if you have cash, right, you would deposit a lump sum equal to the total installment loan amount into the 1031 exchange escrow account. So this demonstrate to the IRS that all proceeds from the sale of the relinquished property directly fund the replacement property purchase, ensuring full tax deferral, including depreciation recapture. However, this option requires a significant upfront cash, making it impractical for many taxpayers. You have option two. So you can make the note payable to your QI. So have the note payable to a qualified intermediary at closing. So the QI receive both the note and any remaining cash proceeds, depositing them into the escrow account. And then you instruct the QI to sell the note back at full price before closing on the replacement property, allowing the entire cash amount to be used for the purchase. You have option three also. So you can use the note to purchase the replacement property. So this might be a little bit harder because you have to convince the seller of the replacement property to accept the note as part of the sale transaction, issuing the note in the name of your QI and then transfer it to the replacement property seller, replicating tax benefits. However, finding a seller willing to accept a third-party promissory note can be challenging. There's one thing that I want to stress once and again: the importance of meeting the 180 days rule of a 1031 exchange. So you have to comply with the 1031 exchange rule requiring completing the replacement property purchase within 180 days after the relinquished property escrow closure. If meeting the 180-day rule is unfeasible, consider an installment sale may be an alternative. Wait, you also have a backup option with this type of exchange. So seller financing via an installment sale. When seller financing within the 1031 exchange timeframe is unattainable, the tax code permits a deferral option via an installment sale. A personal real estate transaction in the early 1980s illustrates this, involving selling rental property with monthly interest payment and a balloon payment in the fifth year. Tax obligations include taxes on all interest income received over the 5-year period, and the deferral of capital gain taxes, still collecting the principal in year 5. Ineligibility of a 1031 exchange is noted due to the transaction colliding well after 130 days following relinquished property escrow closure. Despite foregoing a 1031 exchange, the decision proved beneficial due to favorable interest payment and a higher property price. Alright, let's sum this up. Real estate does allow us to be creative and use all the legal strategies to save tax. So use these strategies to your best advantage. Happy hunting out there!